we're going to do the following thing. And today is a little valuation. We're going to look at three different things. The DCF, and then essentially multiples. The multiples comes in the form of first the transactions and comps. Well, comps first. The precedent for later on. Boom. Okay, what is a DCF? Can you guys tell me? Discounted cash flow. Discounted cash flow. What are you doing with a discounted cash flow? Discounted cash flows.
You need to adjust the value of money for whatever is going to be worth in the future.
Yeah.
So you use a certain coefficient called walk.
Yeah.
To calculate what's going to be priced up in the future.
Okay. This is the discount rate.
Correct.
Discount rate.
Mm.
What are we doing with the DCF? We are bringing the value of money to the present day. To the present day. We are going to call this LVV essentially, which is definitely right to net present value. Okay. So who are we using? Which we did see about a week ago. Who's our god of valuation?
Damodaran.
And what does he do? It makes him the god of valuation.
You know, showering.
What he's doing is he's essentially collecting all the risks from the different countries and the risk from the different industries. He's using that to calculate the cost of equity. Remember that? So what is essentially a product of two different things? How were the two things?
Properties.
No.
Equity. Equity and interest.
Not exactly. You have two different costs: the cost of equity and the cost of debt.
Mm.
What is the cost of debt and what is the cost of equity?
There is just interest towards the principal or just interest. The cost of debt is the interest there.
The cost of debt is the interest. So this point here,
Let's see is
the interest of the debt. What about the cost of equity?
like dividends.
The cost of equity is that. And if you a very tangible number, which is the cost of interest, you take out a loan and you're going to pay 5% on that loan. So that is the cost of interest. But what about the cost of equity? That was extremely, extremely intangible, to the point where, if you ask me, it's sort of a made up number. So what we did with this was pretty much cancel it out because it's a complex. Like there's betas, and for that you're taking away the debt and whatnot. But instead of using a complex formula, what we're going to do is we're going to make WACC 50%. Why? Because that's sort of the minimum return that we want to take out of everything that we do. And because we operate in the small cap / microcap space, what we're going to get is, apart from these two, we're going to get additions to the WACC. Okay. So we're going to calculate, or we would have to calculate the cost of equity and the cost of debt. And then on top of this, we would add some other costs. For example, what can you think of as a risk premium? what things constitute a risk premium. Let's read through. Okay, this we would add to the WACC, depending on this. So what 3 things do you think can we add it onto it, the WACC?
Net debt.
No. So we already calculated the WACC for debt, the WACC for debt, the WACC for equity. We decided that instead of using a complex formula, we're going to use 15%.
Yes, good job, sir.
But then we have to, or we can add to a few things on top of this 15%, making it even more demanding for our valuation. What are the 3 things that we can add on top of this?
Are there any cases open against the company? If there is any legal?
Oh, but that would be that would be part of the thesis. We're doing the evaluation here just as a standalone thing. So the first thing we have to take into consideration is size. Okay. Why size? Because size provides a double-edged sword. On the one hand, you're not going to have a lot of people looking at it, but on the other hand, if you want to buy it, you're usually going to have to pay a premium because
Does size matter?
yes. What the hell is liquidity?
Because you know, liquid, you don't have cash.
The liquidity for a company. The liquidity is simply your inability to purchase a large amount of shares. So an illiquid stock will only have, let's say, 3 buyers and 3 sellers at any point in time. And that makes it so that it's very, very difficult to trade.
Get rid of it.
Yes. So as part of trading, because you're only going to be able to enter and exit the position in so many days, you should add something for size. My standard case is usually 1 to like 4%. So if it's very, very liquid, I'll add a little bit to the WACC. That way I take into account that it is riskier to enter and exit. Meaning, it'll take me like 3 months to get into a position or to exit the position. And that translates into, an additional required discount. It's just adding to the margin of safety, essentially. What would be the second one?
Location.
Come on.
Location.
That is exactly it. It's spot on. Country. Why is country a thing that you need to consider?
Because if you're investing in like a one-dollar country like Burkina Faso, then maybe a bombs a place.
Yes, of course, there's instability about it, like war, but I'd say there's simpler ways of looking at
Inflation.
None assuming inflation. Take, for example, China. China is very famous for being very popular when it comes to, investors and whatnot. It is a massive country, and you essentially have 2 different exchanges. Well, you have multiple exchanges. There's 2 main ones. You have A shares for China, which are the listed in China companies, and then you have the Hong Kong-based companies. Both of them have what is known as a VIE structure, variable interest entities. VIE. Interest. And what is this thing, you will ask? A variable interest entity is a structure, usually based out of Hong Kong or even like the Thailand, that is supposedly equivalent to ownership. So, for example, when you buy shares of Alibaba, you don't really buy ownership of Alibaba. You buy the VIE structure, which means that you have a right to the proceeds of the company. So you essentially have rights to the distributions, the profits, but you don't really have ownership. And because you are not the owner, you should ask yourself, is this riskier? And it is for me, but it's just out of me not knowing, essentially. Okay, and what the hell is the third one? We discussed this before, and it's connected to the fact that you haven't done enough research.
Controversies.
Not controversies.
Scandals.
No. Buenos días. We're going to call this uncertainty slash our choice spent a lot. And this is basically us saying that we're ignorant. Ignorance. That we're ignorant about the company. That doesn't mean it is not a good company or anything like that. It has to do with our ability to buy the company as it is right now, with the information we have right now. So, for example, let's say you have I don't know, done 20 hours of research and you've interviewed employees, but you haven't interviewed management because you haven't finished your process. What you should do is you should add a few points to the WAC in order to make the valuation even more demanding. Yeah. This is sort of the principle of everything. The example of DCF. And I go back to okay. So remember the exercise we did the other day? You're essentially going to have a set amount of revenues, which will lead to, let's call it EBIT. And let's equate this to free cash flow. Let's say you're going to have a 20% margin. We're going to do a little exercise here. Okay. 20% margin increasing up to 25 in 5 years. 20%. Then 1. And I'm going to make this up, but you guys should open your Excels and let's try to do a little exercise. We're going to assume that the growth is 2% and the WACC is yes, no. Okay. So what we want to do is we want to start filling out the table. Mm-mm-mm.
This one there?
No, we're starting an Excel from scratch. Okay, I gave you the revenues, but you guys need to essentially create a table for the EBIT. We're going to assume that EBIT and free cash flow are the same thing. And what we want is we want the discounted bit. And we want the NPV free cash flow. That's free cash flow. This is what we're looking. And for terminal value, what we're going to do is we're going to implement the formula that we did the other day. Remember the free cash flow? It's free cash flow. Or something. Sort of turn around. Yeah, but let me.
So every year they did 20% of the earning.
Let me show you. Oh. We start with 20%, but it has to go up to 25%. Yeah? Okay. So 100, 120, 140, 150, 145. Formula text. Right. And this is going to be essentially this times 1 plus RG. G is 2%. And WAC is 15%. ¿Dónde para guiarme? Yes. Yeah? This is just the formula showing you this thing.
Mm-hmm.
Let's make this a little bit nicer.
You've added G to the equation, right? So it will be whatever the values at the end of the year times 1 plus the growth.
Exactly. I'm going to add it right here because that's sort of like done. But this is the margin, first of all. But technically, this would go down here. Boom. And we'll make this gray. This is a percentage. And it's going to be 20%. And this is going to be 25%. It's just going to be this minus this. Times whatever number. And all these things. Minus. What am I doing wrong here? Plus this thing, sorry. Oh. Do you see how, like, I'm trying essentially to make this a linear growth. So it's going to be the difference between the two.
Yeah, divided by the number of years and multiplied by the number of the year now.
You essentially have to go and add one every year. And anyway, we can just.
Is it? Oh, you hit at 1.2.
Let's just create this thing and we'll do that at the end. And this is this. And the discount rate is going to be 1 divided by 1 plus whatever our WACC is. Let's just make it 3. This one is going to be 5, because it's the terminal value. Yeah? Am I losing you guys? Or are we?
No, which is the free cash flow 20%.
The free cash flow equals the EBIT. So we're sort of creating the EBIT margin here.
So it's 20% of revenues.
It's 20% of revenues, I get. Yeah?
Mm-hmm.
Okay. So let's create this formula properly. This is 1. This divided by 5. So it's here. This is what we're adding every time. So it should be 1.
1 plus.
It should be 125 actually, because we're technically adding 4 years. So 125. And what we're going to do is add 20%. And we're going to multiply this times the previous year. Oh, yes, I think so. Does that make sense? Yes, but we need to block everything. So we block this, we block this, we block this, and we block this. And if we stretch this, it should give us yes.
So it will be.
So we're essentially going from 20% margins to 25% margins.
Yeah, with a linear progression.
I'll show you this formula here.
So it's year 5 minus year 1, the profit margin, right?
Yeah.
Then multiplied by the year before, like by the year we're in, right? By 4.
You have the formula here.
Which one?
This is the formula. This one's the formula. So you take the first and the last year.
Mm-hmm.
So you find the difference, and then you divide it by the number of caps. In this case, it's going to be 4. Let's make this actually year 0, and it'll be easier. Because that way we have a perfect discount. Like the first year is going to be entirely for us. We're assuming we're starting at on December at the end of the first year. So the first year doesn't have a discount, essentially. Yes? No?
Well, yeah. Why did you lock everything in there?
Why did I lock everything?
Yeah.
Because otherwise it's like gonna be a funky formula. Like you need this to be, you need number 4 and starting and ending year to be the exact same for you. Let's make this growth. Black. And I'm gonna make this little. Okay. The stuff in yellow is essentially the most important stuff that we're gonna look at. So I'll do a little review of what we've done so far. We're taking a set number of revenues until year number 4. Yeah. Now we're going to do this thing because we haven't calculated the terminal value yet. This is wrong for now. We're taking a set amount of revenue, okay, until from year 0 to year 4. We're assuming we're starting in December, so the first year doesn't really have a discount. We're taking a growing margin, which goes from 20 to 25%, and it increases by, essentially evenly every year. And we're equating EBIT to free cash flow. Yeah, these two things are the same. It's just for the sake of an example, but EBIT and free cash flow shouldn't be too far away.
Mm-hmm.
That means that we're turning operating profit into actual cash. We don't want a lot of receivables here. We don't want a lot of essentially working capital that prevents us from turning our actual margins into free cash flow. Yeah? Question so far?
And where do you get the margins from? Why is it changing?
We started at 20% and they said we got 25%.
Well, why is it changing?
Because I decided it was changing. There was a growing margin. It's increasing operational efficiency and that makes it a growing margin. Yeah? See?
Okay.
You guys on the same page?
Yeah.
Okay. Now we're going to calculate the terminal value of it. So remember how we said terminal value was essentially the free cash flow per growth divided by this thing right here, divided by the discount minus, I'll write the formula. So it's going to be free cash flow times 1 plus growth divided by the discount. So WACC minus growth. Make this WACC. And I need to give this. Okay, so this is what we're looking for. Because we already did the 1 plus G, the only thing that we need to do is turn this cash flow into the terminal value of it. So we need essentially to divide this thing by WACC minus growth. And this will give us a perpetual cash flow. Yeah?
No.
No?
No.
Does that make sense for you?
Well, I can understand.
Good. This is similar to the exercise we did the other day, whereby what we're doing is we're adding essentially a perpetual growth, which we said it's 2%, to the amount of revenues. Okay, we're doing this formula.
Yes, she's
But at the same time, what we want is to get a perpetual amount of cash flows. So we're taking the previous year, we're using the exact same margins and the exact same revenues. We're adding the growth. And to this number here, to the EBIT, we're creating a perpetual cash flow. Yeah? No?
Mhm.
Okay. And now we're going to look at the discounted cash flow. This would be the multiplication of the free cash flow times the discount rate, which is in this case very demanding, 15%. We're going to make this to decimal places. Yes,
Very bad.
you're very behind. Where are you, kid?
Huh?
Where are you? Where are you?
I've just figured out that I had not enough significant figures, so that's why my formula didn't work for the margin, because I would put the formula in and it would show me that it will be 24%. And I just realized that it was because that I have one less weapons in also.
Oh, okay.
So I need to catch up on the yellow bit now. But I feel like I understand the formula.
Are you on the same page? Punch?
No, not really know which. I don't know if you know it from the preamble.
You do realize that we did a very similar exercise last week. It was just a simplified version. We're doing the full thing today.
How do I move the whole thing upwards so that it doesn't mess with the cells and their location?
You just click on one, secondary click, and you add insert. That's what you want, no?
No, I meant to move like you have revenue. There's
You click Command X, so you cut and you paste.
oh. ¿Cuál es el total value de free cash flow?
¿Cómo que total value?
Well, why is it so big?
What do you mean? As in, like,
What makes the number so big?
you need to be more explicit. On
Do you
every,
get a number so big?
but you mean like the terminal value? Because you're creating a perpetuity. So you're dividing it by WACC minus growth.
What format do you need to use for EBIT margin? Does it have to be gray and
We're not using, like, if we were to use this properly, we would probably make this blue.
Mm.
And everything else would be black, because everything else is a formula. This would technically be blue as well. No? Yeah, I think so. This is blue, and this is blue. This is a formula. It's yeah. Now, where are you guys?
because I've moved it up, they destroyed everything that I had before, like all of the.
Okay, so we need to make this.
We should put this.
This should be here. F3 is correct. This is it, and that is correct.
How do I?
And now you literally take it, and it's beautiful. And remove us, and remove. Did you? So for this one, we're gonna take the EBIT and we're gonna divide it by parentheses 15 minus 2. I get 2 decimal places. Free cash flow.
Free cash flow and EBIT are equal to each other, right?
Free cash flow and EBIT are equal to each other. Yeah.
But
Okay. Yeah. No. Yeah.
and now the discount rate.
Discount rate is 15%. So the discount rate is just the time value of money. This thing right here. So what we're doing is we're turning these cash flows, the free cash flow, the discounted cash flow, because we're turning this into the net present value.
How do you get a discount rate?
The discount rate is just 1 divided by 1 plus WACC to the power of however many years we had it. It's this formula right here.
1 divided
1 divided by 1 plus WACC. Sure. To parentheses. To the power. Oh, this one. You need to block B16. Make that F block everybody. You need to block it, so you put, you know how to. Okay. How to? That is exactly what we gotta just ask. So that, yeah, it's 1 divided by 1 plus wow to the power of the years. The first year is year 0, right? What? Year 0. Okay, so I'm going to calculate this again. 147.9.
Mm-hmm.
2025 31. Uh, 35. $36.20. And that is 284. What the? Okay. Question: how much of the valuation comes from the terminal value?
Can I take a look, please?
Yeah.
No, it's 2 plus 5 on it. Over here, we have it done wrong.
Well, first of all, this one has to be the same value. And why are you adding the... Okay. No, that's correct. These two are the same. So I just did the formula was for that.
So finally, we have to update discount cash flow.
Let's take this one actually, and let's make this one.
The formula for discount cash flow is free cash flow times 1 minus growth divided by WACC minus growth.
Yes, but you did correctly.
Which one?
That is correct. That is the formula. So the growth we added to revenue, the first part of the formula, and the second part we discounted it. So now
I have to do DCF.
Now we're going to DCF, which is that times the discount rate. Not just the discount rate.
Oh yeah, that's it.
Boom. Beautiful.
One, and then the last one would be valuation. Yeah.
776. Seven. Okay. So what are these? Discounted cash flows.
You need numbers.
Yeah, I want the numbers.
20,
20,
22.17,
23.82,
82, 23.82, 23.43, 20.73,
and
73.
and
The last one was 162.62.
62, 60. And the total of this
Would be just the sum of all of them.
is
It would be 272.77. That's what I did.
and so out of the blue, we just did a valuation. Does that make any sense to you guys? Was that a lot of work?
It's complicated. We definitely worked hard on this.
Well, that's why we're doing evaluation now. Okay, now that you have this Excel model, do not erase it because we're going to use it for practical examples later on. Yeah?
Can you help me formatting it like it's like you done it? Same way? Or not?
No. That you have to do by yourself. I'll give you the formula. But if you want to make it nicer, look in there. Okay. Okay, we just did a little DCF. We're going to use exactly the same concept and do a little bit of theory on comps and precedents and use the exact same thing to bring out a valuation on the other end.
So the blue ones are formulas, right?
Blue ones are manual inputs.
Oh, manual.
And black ones are in the formulas. Yes, no, yes.
Yes.
Yes, sir.
Did you change the font for EBIT margin or not? I mean, with the size of the font.
Yes. There's two that you need to change and EBIT margin. Yeah.
Try to make it nice. It's like so.
Okay. So that accounts for the DCF. If we're going to look at the other. Ahora aquí, ¿no?
Alejandro, and the total value of EBIT margin, how do you calculate it? Same formula? What in like here and a half become for like this and this bracket?
Yeah. Oh, well, you just click on equals in the previous one. And that's it. 25. Yeah.
And it needs to be flat, right?
Yes. Or gray in this case.
Gray?
Well, it's gray because it's a percentage and made it gray. Okay. So more on the theory end of things. We just did a little DCF. It was super easy. You guys nailed it from the first time.
That's what I like this.
Now we're going to look at the other side. So, in my opinion, if there's no cash flow, you cannot create a valuation, right? I think you've heard me say this multiple times. Why is that? Because in a DCF with no cash flow, there's literally no valuation. With that in mind, there's companies that have negative earnings or negative cash flows and that can have positive cash flows in the future.
Mm-hmm.
And the one exercise that we didn't do, but that we will do right now, is look at the terminal value. What is the percentage of the terminal value of the total valuation? We call it was 162 out of 272, right?
Mm-hmm.
What is that percentage? What is that percentage as a total? The percentage dependent on the terminal value of the valuation. Do the math.
I don't know.
The terminal value
Yes.
out of the total valuation. So terminal value, DCF, divided by the total valuation. Just to finish up this thing, I'll show you here.
0.9.
Okay, so we're looking at this thing right here. 0.9 is not correct. What is the percentage of the DCF dependent on the terminal value of the total valuation? So 162.62 divided by 272.
262.
272. 162 divided by 272.
60%.
That's 60%. Clear?
I was formatting it.
Stop formatting and
I'm going to get you.
because this part is very, very important. Remember how we did this exercise? What would happen to the percentage of terminal value if instead of a 15% discounted rate, we had a 10% discounted rate?
What happened?
Yeah.
With the valuation?
Well, the percentage that's dependent on the total valuation of the terminal value.
Here we'll get here.
It will get bigger. Why is that? Why is this larger than the other? And that's because now the money in the future is worth more. And particularly the first few years of discounting will be even larger. If we turn this into a 5-year valuation, how would that be affected? Pasarme. Well, wiki, Henry. Okay, so once again, we went from 60% total value. Yeah.
Yeah.
Now we put this, we make this 10%, and it's larger.
Mm-hmm.
It's going to be 72%. That is the case because the present value of this terminal value is going to be significantly larger than the rest.
Mm-hmm.
Money in the future is going to be worth
Way more.
way more. Exactly. If we
Market
make this
smaller. If they walk smaller, then an MPV is going to be larger.
ish. Yeah. So if we make that 5%, it will be even larger. It's going to be next to 90%, right?
Mm-hmm.
And the reason why it's close to 90%. So we're making this 10%. And we're making this 5%. See? This percentage, I don't know what page this. I should have how I got this percentage, the percentage in the terminal value of the total value, this is going to be larger because, as you said here, the money in the future is worth more.
Mm-hmm.
Yeah.
Yeah.
With that in mind, if we put 15 back onto that little cell, it's still 60%. What does that tell us? Then most of the value is in the future. Exactly. What does this mean for a company that, for example, is breaking even right now or losing money right now, but that will make money in the future, as in like within in 5 years or more? Well, we can find that out by changing the EBIT margin number. Okay. So the EBIT margin is at 20% right now. We're going to take that down to minus 10%.
In year zero.
In year zero, yes. If we turn the formula correctly, what this will do,
10% means that they don't have any revenue, profit.
they're losing money.
Yeah.
Okay. So if we turn this into negative and you look at the total value, the valuation will not change as much.
The valuation didn't affect me at all.
Well, oh, you need to make that minus 10.
Yeah. So the percentage changes.
Why isn't that much actually? Okay.
So again, they will.
Yeah. This is manually input.
Yeah, you know, only.
Yeah. Yes. No.
Didn't change. Is it? Do you have a summary number? Yeah.
I think so. 196, right?
Yeah.
196 again. Does that make sense?
Yeah.
Because now the first years are negative,
Mm-hmm.
and you start making money in effectively year 3 or year 2.
But now there's some general.
But the valuation,
Even larger.
it's even larger, but that's only because we have negative numbers at the beginning.
Mm.
The whole point of it is that the valuation didn't change as much as you would think. Why? Because most of the value is created in the future. Yeah? See? No? Going back to that was the hardest part of this one. Now we're going to look at comps and precedents. What the hell are comps and precedents? Comps and precedents are just multiples. So we're going to take one of these numbers, usually the free cash flow number, and we're going to multiply it by a random number. Let's call it a random number. This is usually how people make M&A transactions. So Usually the M&A transaction is I'll average the industry, I'll take the average transaction in the industry and I'll be like, okay, so everyone else is paying 5 times EBIT or 5 times EBIT. And that will be the number I apply to my valuation. Is that, how correct is that? Is the question. How accurate is that?
Allemaal dashboards since you know some of that. The networks. This one was way more than one.
Well, what ends up happening is in good times, people will be like massive. Yeah. In good times, people will increase this number by a ton.
Mhm.
And in bad times, they will decrease this number by a ton just because the willingness to pay will decrease and increase with the times. Does that make sense? So in a market where people are doing a bajillion transactions, this multiple will increase. Let's give it a baseline of 6 times. It will go up to, I don't know, 10 times. And in a bad market, so you're going to have this cycle of the multiple that is pretty much irrelevant or it's not connected with the actual results of the company. Yeah?
Mm-hmm.
Does that make any sense?
Yeah.
Okay. This will create, in my opinion, a lot of misleading transactions. Some transactions that are priced at 10 times should not be done. And then some transactions that are priced at 4 times are just way too cheap. Why? Because it doesn't really assess value. What is the difference between comps and precedents? It's fairly easy. Comps are just the people around you. So you will take companies from your industry, at their current price. And you will average it out. So let's say, you're in the random industry, the sofa manufacturing business. You'll have 10 companies and each one will have a multiple, usually in the form of enterprise value to EBITDA or free cash flow. And they'll be listed. Let's say we have 10 companies, so it'll be 10, 9, 8, 0. And the average of it is going to be your comp multiple. The same thing goes for precedent transactions. Oh, first of all, what was EV? The formula of this. Do you remember what this was? We sort of looked at it last week.
Sure. Market cap and then that's the company.
It is market cap plus. Okay, what does this mean?
What does market cap mean?
Yeah, what does this entire thing mean?
Is the number of outstanding shares multiplied by the price and whatever that the company has. So you subtract probably that's just it's no, I mean the number is negative, right?
By the bank zone. What's the net debt, first of all?
That was not it. Percent that what profit that was
and so you're adding essentially how this thing is financed to the value-ish of the company. And you're getting the enterprise value. So the enterprise value is just the debt/cash aggregated value of the valuation plus, the financing essentially of it. Yeah? No?
Yeah.
Okay. That was essentially comps. What is precedent transactions? Precedent transactions are just a series of transactions that have been going on for the past, let's call it 5 years, which you will look at and you will do exactly the same as comps. You will look at them and you will be like, okay, so what is their enterprise value over EBITDA? Or what is their enterprise value over free cash flow? And you get to a number which can be anything from 1 to 20. And I'm making an under that one. If you technically up to 100. And you will use that, or you will use the average as your valuation. Once again, why is this not very accurate? Because it's very cyclical. It depends on whatever time it is. What I use for multiples is extremely, extremely simple. I used 6x as my standard. Why 6x? Because we're using the discount rates, exactly the same discount rate. We're using 15%. What is 1 divided by 15?
On 0.0667 63.
Exactly. So you essentially have a 6.66666. And because we're lowering it, just to be precautious, we're going to use a 6 times multiple. This, in my opinion, makes a lot more sense than the freaking, waiting for the industry to do its thing. Does that make sense? So we will use 6 times free cash flow. Now we're going to go back to the model and we're going to do a little calculation. And then we'll take a little break. Okay?
All right.
And that will be the first part of the session. And check with you guys here. Oh, blah. Okay, so multiple. We're going to do this. We're actually going to format this. Don't know if you've ever done this, guys, but you can essentially turn this into whatever you want. In this case, an X. We'll get 6X. Where do you get it from? That was a little formatting tip. You click on back custom. So there's more number formats. You click on custom and then you add this little thing. So the output would be like this. Yeah.
Or if you type it, oh yeah, here.
We're gonna take this over here.
For me, it does, when I do this, it ends up being 6.67. And if I choose less significant figures and just route to that, what should I do? Just, it's a manual input or not?
You can just put 6. It's just okay. We are going to just take the free cash flow numbers, which in this case are 20 and 25. Yeah.
Yeah. 25, 50. Yeah.
Not the DCF ones, huh? Just the free cash flow figures.
Mm-hmm.
We're gonna say this is the free cash flow for year 2025. And that's for 2026. And we will just multiply that. This times this.
let's call this equal to this. Let's make this blue.
Yeah. No.
Yeah. Why'd you choose a double border? Is it like the accounting standard for?
No, I just like it as a total. But you can make it anything you want. Okay. This, 6 is not so much the actual valuation of a company, but rather what we're willing to pay. Does that make sense? Because we're looking for a 15% yield.
Mm-hmm.
If you look at our valuation from a DCF, discount. A little discount, and we're going to make this 15%. 50% is what our margin of safety. Remember that concept? What was the margin of safety? Can you explain margin of safety for me?
It's how much you are discounting for the case some unforeseen circumstances happen, and how much you are willing to risk for it.
It just is your ability, well, in this case, your precaution when it comes to actually purchasing something.
Mm-hmm.
So with a discount of 50%, we're going to get 136. If you look at the multiple for the next year, for the next 2 years, what do we get? We're getting between 120 and 153, which matches with the buy purchase, like the purchase target. Yeah?
Yeah. Mm-hmm.
And that is exactly what we want, which that essentially means that both of our valuations are pretty much on target. We don't know whether it's worth 120 or 153, but we know it's in that range.
Mm-hmm.
The DCF will give us a much more accurate number, in this case 136.
Mm-hmm.
But the whole point of it is to have a purchase target. The actual value of this will probably be closer to a 10x multiple. So it'll be priced at like 200 to 255. But we want to look at the purchase price. Yeah. If we use 10 times multiple, it's usually where things are trading at. But we want to purchase it. And because we want to purchase it, we want it to be at this price. And this makes it so that we come essentially full circle. I will make this the it. Boom. A boom. Yeah. Questions? I was a little complex at the end, but I'm pretty sure that multiples are easier for you guys than the DCF. No?
Yeah, 100%. But do you begin by using the multiple model, and then once you want to get the actual number, you do the DCF, or you always begin by doing the valuation?
Well, which one is quicker?
I mean, definitely this one's quicker, but you get a range which you don't know where the price
It's a much broader range, but
yeah,
what you want is to discard companies, right?
Mm-hmm.
So because you want to discard them, and if they're not in the range.
So you're kind of like first filter is using the multiple model, and then once you see that the company is aligning with the objectives you're trying to pursue, you will get deeper into it and you will use the DCF model.
Exactly. We're going to do a little break.
Was there also a third one we were talking about last week?
Well, technically these two.
Mm-hmm.
But in the end, it just comes down to a multiple. The two are comps and precedent transactions. But it just comes down to whatever multiple you have. It just comes from different sources. So these are closed out transactions that happened in the recent past. And this is just how are the other companies in the industry trading right now? Yes? No?
Yeah.
Maze boss. Oh, okay, you can go on a break, have 20 coffees. And how am I gonna do this? So that any questions on your end, guys? Were you able to follow the explanation more or less? More or less. I'll give you guys back the model in a second. Figure this out. What do that?
What?
¡Opla! Vale. This was the first part. Beep, 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 beep. Beep, 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 beep. Okay, now we're gonna actually do examples of this stuff. Vete y pídete un cafecito, Erwin. ¿Te lo has hecho? ¿Dónde te cafecito? Sí, no, sí. Okay. Now that we have sort of done the multiples and DCF, we're gonna sort of use that to analyze modern companies. We'll start using the ticker app, so you guys have to like come over here, which will make it easier. And then we're gonna look at some of the filings, because filings will be very useful when it comes to making these assumptions. Yeah. Yeah. Want to calculate the free cash flow multiples, because that's sort of how we're going to do the initial valuations of all of these. Okay. Let's get the name of a random company. Name of a random company. Oh, we're going to start with Iberdrola, actually. Yeah, we saw this. We were yesterday with a guy from this company. Remember this thing?
Bonds.
Bonds, exactly. Green bonds. Okay. So Iberdrola, renewable energy in general, but renewable focused energy production and distribution company. They're originally from Spain, but they do a bunch of other countries. As you can see here. This is just an aggregate of their accounts. Okay?
Mm-hmm.
But what we want is the free cash flow numbers. So total revenues, we're seeing growth, or what are we seeing here, guys?
It's pretty stable. Or
From 2016 to, let's say, 2024.
yeah, we see growth.
See a little bit of growth. It's like
But it's not stable.
1.5
they had
2x.
Yeah.
What about the EBIT margin? This thing right here.
Also,
It's going from 15%
to 25.
to 25. 25 would be extraordinary, but we can probably say that 18 is, among something that is expected. Perdón, está enchufado. Okay. So with this in mind, what else should we be looking at before we do a proper valuation? We want to look at the net debt. So cash, about $4 billion. This is where our guy works, in cash and short-term investments. And then we're going to look at long-term debt and short-term debt. So short-term borrowings is very low. This would be the portion of the long-term debt. So about 13 billion, and the long-term debt is 40. So we should expect 40 plus 14, 54, minus 4, about 50 million, right? Debt, according to this thing, is 55 million. So probably adding up capital leases probably capital leases. This thing here. And some other. Okay. So 55 billion in debt, in net debt. What is the valuation for this thing? These are the free cash flows. We're just using aggregate numbers, but it's exactly what we did there. We're going to look at how to calculate it in filings in a short second. Free cash flows. How much are we willing to pay for this company? We should obviously project this to 2025 and 2026, but approximately, with a steady cash flow, these, by the way, are the margins on the cash flow. So just like we had margins on EBIT, we have margins on cash flow. So let's call it what? 8%-ish? How much would we pay for this stuff?
If we get that in the formula, we can get it. No?
We don't really need a formula. We just need a multiple. What are we multiplying by?
0.4.
We're multiplying by 6 times. It's as easy as 4 times 6. 24. Yeah. 24, basically. 24 is the enterprise value. What does that mean?
For a discount, 50%. Yeah.
No. We don't need to discount anything because we're already using a 6 times multiple. But the enterprise value needs to get the net debt subtracted to get to market cap. When we buy a share, we will buy the market cap, not the enterprise value. So it would
subtract the net debt from the market cap. Yeah.
Exactly. So we would be subtracting what? 24 minus
net debt. What was the net debt?
More? 55.
55 billion.
55 billion, yes.
So it would be negative?
It would be negative. Oh. What does that mean?
Well, we shouldn't buy it.
This is their actual market cap. Their market cap is 100 billion.
Uh-huh.
And their enterprise value, so market cap plus net debt, is 174. I don't know how this gets calculated, but it should be 55 or 57 technically. Anyways, there's a gap, but let's call it 100 and like 150. Is this overvalued or undervalued?
Overvalued.
Super overvalued, right?
Yes.
What is the market sort of expecting with this?
for it to go down.
They expect massive cash flows because otherwise it wouldn't be valued like this. So we can actually do the inverse. What is the market?
The stock.
No, we're not charting anything. We're only going along, but that's not the point. The point is we want to get to a valuation. What is the market discounting? Let's use a 10x multiple, which is sort of how it should be valued approximately. The market is discounting 10x over 100 million in market cap. In cash flow terms, that is 10 million bucks or 10 billion bucks. So the company should be generating 10 billion, next year or the year after. How possible do you think that is?
Pretty much impossible.
Pretty much impossible. That would be my assessment as well. Because this is sort of a legacy business. It's a business that's been here for a while, and sure, there's going to be growth, but it's very, very, very hard for them to get to 10 billion in free cash flow. Yeah. Quick recap: 100 billion divided by 10, which is the multiple, is the cash flow people are expecting. So 10 billion. Yeah. How much would we pay for it?
24 billion.
We would pay 6 times
the free cash flow.
The free cash flow.
Yeah. But that's a poo-poo stock, yeah?
It is poo-poo stock, yes. That is one way to describe it. Poo-poo stock. Okay. Random company.
Race. Gazprom.
Race. Ferraro. Okay, so we're looking at Ferrari. You guys know what Ferrari does, right? It's
more. I can assume.
I don't want you to see this, but okay. So Ferrari, nice little income statement. They went from about 3 billion to 6 billion. We can see the growth here. Pretty nice, not gonna lie. What is their EBIT margin? About what, like 25%? We look at them throughout the years. Right now, it's at a peak at 28%. Huh? Pretty good. Gross margin. What does a 50% gross margin mean?
And they produce themselves, but they don't know.
Exactly. That it's their own product. There's going to be parts and whatnot, but a high gross margin, so 50, 60, up to 80%, that will indicate that they have their own product. For that, they're a service-based company. In this case, because there's a product and it's a very recognizable product. Okay. Net debt. How much is the net debt of this thing?
Cash is around 1 billion. No, 2 billion.
1.7. Technically, you can count cash and short-term investments as cash.
Yes, yeah.
Let's just do cash for the sake of it. 1.7. And then
the total liabilities.
We're taking this
2 billion.
And we're taking
6.
This.
Oh, yeah.
So what is that? 3.2 minus 1.7.
1.5.
1.5. Is that correct? That is more or less correct. 1.6. Okay. So to the market cap, we're adding the to get to the enterprise value. Same thing as before. Cash flows. Okay. That's pretty healthy cash flow, 25%. If you look at this example versus the previous one was 50% of EBIT. So it went from a margin of like 20% to a margin of 8-9%. These guys have a very, very close free cash flow margin and EBIT margin, meaning that a lot of the EBIT, a lot of the operating cash flow, or a lot of the operating profit turns into cash, which is what you want in business. Super important. Does that make sense? You seem very confused.
Yeah.
Okay, so how much are we gonna pay for this? This is the pay-in price, huh? Not the how much this is worth.
9 and 7 to 9.
What?
Which is that times 6.
11. 1.7 times 11 times 6.
1.3. I thought it was more before.
Yeah.
It's 1.4.
10.4.
I would probably take this number because
1.7, yeah.
because
Multiplied by 6.
what we want to multiply is the cash flow of the next 2 years, right? But we're just looking at it from the get go, so we're sort of having a mental framing of how much it should be. Yeah.
Mm-hmm.
Let's call it 1.8. 1.82 if you want to like project this times 6. That's
15. 15. No.
Yeah.
Oh no. Triple balls.
Yeah.
That's
Your
around
quick maths
10.
was not very quick or very maths.
You only assume it's 2, that's like 12. But
10.11.
Let's call it 10, 11. Yeah. Okay. 10 or 11.
Hello, yeah. 10.8.
Okay. How much are people paying for it? No. Doing this on a very simple, quick maths basis, in order to get to like a proper valuation, you would have to go into the assumptions. I'm just giving you a general scope of how people are pricing stuff. Would you buy it?
Probably not.
It's all movement.
Okay. What is the market discounting? So let's assume that the market is discounting 10 times free cash flow. Maybe in the case of something like Ferrari, because it's very, very good in terms of when it comes to like competition, when it comes to pricing, when it comes to essentially luxury good. Let's give it a 12 times multiple.
Still, it's nowhere close to a real.
Oh yeah. I'm just asking how much, what is the cash flow that the market is assuming with a 12 times multiple?
That there's going to be huge growth in the next near future.
Yes, but I want the exact number of free cash flow that the market is assuming with a 12 times multiple.
Oh, so it would be 1.8 multiplied by 12.
Well, it would be 70 divided by 12. Because that's what the market is implying.
So,
It's like 5.5.
Yeah.
17 divided by 12.
70.
7.
Oh, yeah. 70.
5.8.
5.8 billion in free cash flow. How realistic is that?
Very realistic.
That this company makes 5.8 in like the next 2 years.
0.
It pretty much is. It's very into the company, and there's obviously a lot more to do. We're looking here once again, cheap, only from the quant perspective. We're looking at
every single company's own value.
No, there's but some of them are, because the market just pushes the prices up, and people end up doing multiples valuation. So if we look at the actual competitors and how this thing is priced, you'll get some crazy ass valuations. So these guys are priced at 25 times EBITDA, but look at the competitors: 7, 7, 7, 6, 2. Okay, this is just unrealistic. But a lot of it is not that pricey if you look at. It's also not a very good business in general. Huh? Like cars, they have their own thing. You have a lot of pressure in Germany, for example, and that affects all the German automakers. Stellantis is like what was formerly called Fiat Chrysler.
Yeah.
Fiat Chrysler. But look at these guys. Would you say these are overpriced in comparison to?
No, they're not.
Okay. Why does this have such a big premium?
Because it's a luxury.
there's a premium, and then there's like 5 times, which is, like what is the average of this? So like 7 times. So 4 times as much as the average of or the median of it. Completely to you.
That's still the plan. It's relevant, but